3.5%, if you've taken out a significant mortgage, 3.5% is painful.
Yeah.
When you're used to 1.5%.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined by my Fidelity colleague, Tom Stevenson, to talk about the health or otherwise of the UK economy right now. Last week, we had an interest rate decision by the Bank of England that ultimately ended in no change to rates. They stayed at 4%. But the surrounding commentary did suggest that the outlook for the UK economy may be shifting just a little. Before we get into the details of that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments if you want to do that. It really does help others find what we're doing here, and it means that you're going to get new content as soon as it is released. That said, Tom, welcome along. Tell us what happened at the Bank of England last week. We thought it would be a fairly straightforward decision, but it ended up being a bit more complicated than that.
Yeah, I mean, there was some doubt about whether there would be a rate cut last week or not, and indeed the sort of the odds on whether that would happen or not changed in the run up to the meeting. When it actually came to first of all, the context for the meeting was that the previous week we'd had a rate cut in the US.
You did.
No rate cut in Europe. So, I mean, central banks don't always move in lockstep, but they do tend to follow each other a bit because of the impact that interest rates have on currencies is one factor there. Anyway, so one big bank did cut, another didn't. When it came down to it, it was a very tight call.
Yeah.
It was a 5-4 vote, and the governor of the Bank of England, Andrew Bailey, had the casting vote. So in the end, there was no cut, but the commentary around it very much pointed towards a gradual reduction in interest rates. So it has become a matter of when, not if, rates are going to fall.
Yeah, and there are certain things that the bank said that we'll come to, which I think sort of denote a slight kind of tipping point. We can work out a little bit about what the market thinks when it comes to rates by looking at the bond market. Mm-hmm. Bond market prices tell us where the market believes rates will go to. A few weeks before that interest rate decision, it was suggesting very little chance of a rate cut last week. As it was a 5-4 vote, and the governor split that vote. Why did the odds of a cut increase in the days before that decision?
Well, I mean, principally the odds increased because the markets took the view that a rate cut was becoming more likely. That's the general picture. The specifics was that 2 days before the announcement of the rate decision, the Chancellor, Rachel Reeves, staged a pretty unusual intervention. She had a press conference, an early morning press conference a week ago today, at which she talked about the challenges that the government was facing with regard to the budget, which is in 2 weeks' time. Now, that was the timing of that was pretty interesting. What she was kind of pointing at, she didn't actually explicitly commit herself to anything, but what she was pointing towards was an increase in income tax, so a breaking of the manifesto promise not to increase income tax and VAT and national insurance. That's important from an interest rate perspective, from the Bank of England's perspective, because effectively what she was saying was, I am going to put in place measures which are likely to be disinflationary. Yeah. They're going to slow the economy down. So in a way, it was a kind of green light to the Bank of England to cut rates at some point, maybe not that week, although that would have been one possible conclusion that the Bank of England could have drawn from that. But effectively, it was saying, as a government, we are serious about getting on top of inflation, and that it opens the door to interest rate cuts.
Yeah, on top of inflation and on top of the sort of whole sort of fiscal picture, or as much on top of it as they can be. This is sort of beside the point of our conversation today, but I was slightly, that speech that she gave, I heard, read some sort of reaction to it, and lots of kind of, traditional media being very sort of worked up about why she would give a speech like that, and people basically find it boring, a terrible way for a politician to communicate. And I thought it completely missed the point of the audiences for that.
Totally, I totally agree. I mean, she had three main audiences there. One was us, the voters. Because if you're going to break a manifesto promise, then it does kind of make sense to
look them in the eye and tee
people up and manage expectations a bit. The second audience was her backbenchers. Because one of the problems that the government faces is an inability to cut spending. And one of the reasons why they can't cut spending is because the backbenchers just won't allow it to happen.
They tried to,
and they had to backpedal on those cuts in spending. And then the third audience, and probably the most important audience, and I think this is what you're referring to when you say that the commentary missed the point. She was really talking to the financial markets.
Yeah.
She was saying, we are serious about getting on top of the fiscal challenges the country faces, balancing the books, getting on top of inflation, and this is how we're going to do it.
Yeah, and that formed some of the context for those MPC members. Inflation obviously forms part of the context as well. Now, the September figure for inflation, which came out in October, at 3.8%. Lower than expectations, and crucially lower than this 4% level that the bank itself had said it expected inflation to reach in September of this year. That's obviously sort of, perhaps allows for a bit of a softening at the bank. But what we also got last week in the minutes for the MPC was the acknowledgement that they think inflation has peaked at 3.8%, so therefore lower than they thought. That felt significant to me that they had the confidence to say that inflation would now be on a downward path.
Yes, and I think that a week is a long time in politics, as they always say. And just today we have had data which confirms that judgment by the Bank of England a week ago that inflation had probably peaked at 3.8% is almost certainly correct, because what we had today is labour market data, so unemployment and wage growth, both of which were pretty disappointing and worse than expected. So unemployment hit 5%. It was expected to rise from 4.8 to 4.9. So, okay, so only a little bit worse, but it is worse. The jobs market is clearly extremely difficult at the moment. I mean, talk to anyone who's out there looking for work at the moment. It's very, very hard. And wage growth was very interesting because the private sector wage growth is starting to fall back quite significantly. Interestingly, the public sector wage growth it actually rose to 6.6%. Public sector was down to 4.2%, and that is part of the problem. Of course, this is a high spending, government, and part of their spending is on public sector wages. But anyway, coming back to the inflation point, I think both the labor market, unemployment, and wages are pointing to a turning point in the economy. And then later on this week, we've got GDP figures on Thursday, which are also expected to be a bit weaker than they were in the 3 months to September. I think it is a bit weaker than in the 3 months to August. So there's definitely a slowing going on in the economy, and that will impact the inflation rate.
Yeah, and that marks a change because the UK has been a bit of an outlier on inflation. Certainly inflation has been higher here. Why do you think that is? It's obviously meant that rates have had to stay higher for longer. Why has the UK got that particular issue this year?
I think there were quite a lot of reasons why the UK is a bit of an inflation outlier. I think high energy costs is one part of it. The UK is more dependent on natural gas for the generation of electricity, so it was hit pretty harder than most countries by the Russian invasion of Ukraine. So that was one of the reasons why inflation spiked higher in the UK than elsewhere. Food costs have been persistently rising. Partly that's to do, well, in quite a large part actually, is to do with rising costs of retailers and food companies generally, and that's a product of decisions that were made a year ago in the budget with the national insurance hike on employer national insurance contributions. So energy, food, mortgages is another issue. Mortgages in the UK are more geared towards short-term rates than, say, in the US, where people tend to take very long-term fixed mortgages. So they're more exposed to rising interest rates. A lot of this actually comes back to Brexit and the tighter labour market as a result of Brexit. We're still in a way feeling the effects of what happened 10 years ago. So, energy, food, labour market, mortgages, there were lots of reasons why the UK is a bit of an outlier.
Yeah, and something else the Bank of England Governor Andrew Bailey said last week is that he expects rates to fall perhaps two more quarter point cuts, and then level out at about 3.5%. That's what the bond market suggests will happen. That's the best guess for what they call the neutral rate, where rates are at a level that neither constricts nor kind of adds fuel to the economy. Put that in some kind of historical context, Tom. Were rates to level out at 3.5% and stay there, how much higher is that compared to history? Is that normal, abnormal?
Yes. Well, you ask how much higher is that compared to history. You might also ask how much lower is that compared to history, and it depends what history you're talking about. So if you look at the longer term period, say from, let's say, the last 50 years, I think the average from 1975 to now is about 9%. It's quite a high figure. But if you look back over the last 15 years since the financial crisis, the average is considerably lower than where we are today. So it depends what your time scale is. But clearly 3.5% would be, a normalization compared to the abnormally low interest rates that we've experienced since the financial crisis. And I think that has a very significant impact on the economy, on the potential growth of the economy, because as a nation, we have become used to very cheap money, and it's boosted the price of property in this country. And 3.5%. If you've taken out a significant mortgage, 3.5% is painful. Yeah, when you're used to 1.5%.
Yeah, and lots of people will be in that position. But of course, immediately before we had the very low rates following the financial crisis, rates were at sort of 5 to 6% for a long time. Yeah, and that was all normal back then.
Yes, I mean, I remember back then it did feel like 5.5% was a normal neutral rate of interest. That's what you expected interest rates to be. If they stayed at that level now, I think people would find it very difficult.
And it's very difficult always to disentangle, the relationship between rates and, say, stock markets. But clearly, if we had 3.5% interest rates, the normal thing for cash, it might not, again, there's been this abnormal period since the financial crisis, but the normal rates for cash tend to be just a little bit above base rate. So say cash rates are around 3.5% to 4% as well. What then do people need from their investments to make that risk worthwhile?
Well, I mean, typically, the return from equities is higher to compensate investors for the extra risk, the extra volatility of the stock market. So they might be expecting, say, 5 or 6% on their shares if they were getting 3.5 to 4% on their equities. Now, that's considerably lower rate of return than we've had in recent years. And it's probably quite a reasonable expectation. If you look at the very long run history of stock market returns, they've probably been a bit higher than that in nominal terms. So I don't think I think it's not an unreasonable expectation that you should get 5 or 6% from stocks. You won't get it every year because that's what happens to stock markets. They go up and down. Some years you'll get better, some years you'll get worse, but it's not a bad long-term expectation.
Okay, finally then, Tom, all of this comes in the context of the budget, which is happening, as you say, in a couple of weeks. Lower rates would certainly help Rachel Reeves. She won't get them before then. What will she be aiming to achieve with the budget from the market's point of view? I suppose we're talking about the bond market here.
Absolutely. I mean, what the Chancellor is very keen to do is to maintain calm in the bond market. We've had experiences with the Liz Truss situation 3 years ago and other periods in the past when the bond market has held the government to account for its fiscal policies, and that's particularly true of Labour governments. For historical reasons. And so the one thing that Rachel Reeves will want to do in the budget is to be really clear to the markets that she is disciplined about the fiscal, the public finances. And that is ultimately what she wants to do, because if she achieves that, and she can keep bond yields at a manageable level, that's a significant benefit to the government. The government spends a little more than £100 billion a year just simply servicing the debt. That's interest payments on the debt, more than £100 billion. So, if you can keep interest rates 1 percentage point lower than they would otherwise be, that's the thick end of £20 billion. People talk about a hole in the public finances of £20-30 billion. Well, she can achieve most of that by keeping interest rates low. So that is her primary consideration.
Okay. Well, we've covered loads there, Tom, so let's leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share the episodes. That will help people find what we're doing here. That all said, Tom, thanks for joining me.
Thanks, Ed.